Garwood, Editor-in-Chief of ABF Journal. Joining me on the podcast today is Kory Wilcox. Kory, I'm excited for you to be on the podcast today. Can you tell us a little bit about yourself and your role?
Sure. Nice to meet you, Rita, and thanks for having me on. Kory Wilcox. I work at TD Bank North America and lead our middle market sponsor finance effort, as well as the buy side loan syndications effort in coordination with our banking relationships across the street. I've been with TD Bank for just over a year and a half. I came over in January of 2024 as part of the Cowan acquisition made by TD. Previously, I spent 6 years with Cowan, leading the sponsor-backed debt advisory practice there. And then as TD came, to acquire Cowan, it became apparent that we wanted to kind of have a dedicated sponsored finance strategy effort here at TD Bank, and so made the move from the investment bank in January of 24 into the commercial bank to lead that strategy, and have been pushing on that ever since. So great to be here.
We're excited to have you. It sounds like you've been doing a lot recently. Um, I wanted to just get started off with your view from the front lines of everything that's happening in the middle market. How would you describe the state of the middle market right now in the middle of Q3, where we are? Are there any standout shifts you're seeing in client sentiment or in deal appetite?
Yeah, I would say probably cautiously optimistic. We've certainly seen deal activity pick up over the last month, and here certainly in early August, the first couple weeks of the month here. We're still not seeing the tremendous amount of kind of sponsor to sponsor M&A volumes that we would like, but we've seen the M&A markets pick up more as it relates to add-ons, whereby existing sponsor-owned portfolio companies are bolting on more of the founder-owned business. We've also seen a steady amount of opportunistic refinancings, dividend recap transactions as those same portfolio companies kind of await the right timing.
So we've been in kind of an elevated interest rate environment for a while now, and we keep hearing about potential cuts coming down the road. Tariffs have also been a huge discussion this year. It feels like they're changing every minute. There's something new going on. So there's a lot of noise in the market. How are middle market executives recalibrating their capital strategies in reaction to all of this?
Yeah, I think you kind of hit it on the head of the moving parts component of it, right? I think operators are starting to become more comfortable, I guess, operating in this market of kind of continued uncertainty or prevailing uncertainty, as the initial kind of shock of the tariff environment wanes, as the administration is able to finalize deals with our trading partners. But again, as you said, there's still a tremendous amount of moving parts, and as more and more trade deals are negotiated, I do think it'll allow executives to better plan for upcoming capital allocation strategies and make decisions. So they're constantly recalibrating is probably the best way to put it, but it does seem like they're becoming more comfortable.
That's good to hear. So, is this uncertainty that everyone has been experiencing, are you seeing that causing more capital to sit on the sidelines, or are you seeing more pockets of strategic deployment?
Yeah, I think so. I think you're seeing more capital sitting on the sidelines. We certainly saw that be the case through Q2. As deal volume kind of slowed down, we did continue to see some M&A opportunities, but certainly volume was noticeably lower. Where we did see pockets of activity, were more in certain sectors of U.S. based services, consumer, maybe notably food and beverage, franchise, those industrial companies which were not quite as affected by the tariff environment, be it either through manufacturing, all US, or not as much of the sourcing coming from non-US. But certainly the tariff environment, saw the kind of the capital slow down a bit.
So you've written about more collaborative and creative deal structuring. Can you share an example of how sponsors and lenders are thinking outside the box to get deals done and across the finish line?
Yeah, I would say it seems like they're in this environment, they're always thinking creatively, right, about their sources of capital and not just in this environment, but in any environment, probably for that matter. And, I think at the scale of where our group works with sponsors in kind of that 20 million plus of EBITDA range, they have the full breadth of capital providers available at their disposal. And, be it bank lenders, which we are, non-bank or private credit, and in some cases, if large enough, even the institutional kind of broadly syndicated markets, be it the terminal B and high yield markets. And I think where TD is unique and in a unique position is we can kind of go to provide those solutions to clients and often encompass one or two of those groups of capital. And where I sit in the commercial bank, we're providing more of the ABL product and the pro rata cash flow product to clients. Yet we can accompany that with the assistance of our colleagues at TD Securities, who can help source private credit facilities or provide underwritten leverage finance products if the business is scaled enough. And we've certainly seen that as we've scaled with some of our clients, we're often talking with them and approaching a client with a menu of options and discussing kind of the pros and cons of each, and let them decide what matches up best with their investment thesis and strategy. So it's a unique place given the having the commercial bank tied to the investment bank, and really be able to provide all the capital, different capital buckets, if you will, to our clients.
So you work with sponsors all the time. How has the role of financial sponsors evolved in this environment? Are they playing a more active advisory role with their portfolio companies? Are they doing anything differently than they may have done in the past?
Yeah, I think in the discussions I'm having, maybe, they've become a bit more inward focused on the portfolio companies, making sure just, kind of more double checking that the cost structures can absorb any potential impacts of kind of this uncertainty environment that we're operating under. But I also think, that said, it's also a good time to pick up, the strategic add-ons that I mentioned earlier, and which can also provide further diversification and scale, and also help absorb any of that potential impact to the uncertainty. So I feel they're potentially a bit more inward, but that said, are still always looking for growth.
That's good to hear. So the M&A market has been pretty slow earlier this year. Are you seeing signs of life in middle market deal flow? Um, are you optimistic? How are you feeling about deal flow when it comes to M&A right now?
Yeah, I think yes, I would say we are, seeing signs of life. As I mentioned before, the amount of acquisition financings and new platforms or LBOs that are seeing in the market today and have seen since kind of the beginning of July really picked up as it relates to Q2. And so I think that while it's still slower than we would like, we're certainly seeing green shoots in there, and hope to see that continue to build post Labor Day.
That's good to hear. So, where are you seeing valuations land in this environment? Are sellers adjusting expectations? Are we still stuck in a bid-ask spread standoff? What's like the norm right now?
Yeah, it does feel like we're still operating in a bit of a discounted valuation environment, just given where interest rates are lying compared to where a lot of the sponsors entered these deals in the 2021 kind of 22 timeframe. But that said, I do feel that we're seeing some thawing in that spread standoff, given the amount of activity that we've seen, even just over the past couple months. I think that does a lot to really bolster our view on, as interest rates do go down, we certainly see that becoming, a much less kind of sticking point as it relates to the environment.
So how is TD Bank positioning itself to support clients through this environment? Are there specific strategies that you're recommending to sponsor clients right now?
Yeah, I would say with what we have a very clean portfolio to date. Knock on wood, we're very much open for business and looking to grow with our middle market sponsor clients. And I think that the main thing is just proactive communication. The most important strategy we're recommending is get us involved as early as possible. Specifically as it relates to these refis in context of an add-on acquisition or a distribution, and we can certainly do more and try to be more the more creative we can become with the more time that we have. And so that's really it. It's a just communication, trying to stay in front of them and be there as a soundboard.
So how do you balance prudence with opportunity when you're advising clients who are hesitant to move in an uncertain market?
Yeah, it's a good question. I also think though that I think it's something that should be balanced in any market, regardless of the environment, and certainly something that I know our executive team and colleagues are always striving for. The more we are in front of them, communicating on with them on what's most important with them, what's the best product or service to match their strategy, in a somewhat slower deal environment where competition to win new clients is heightened, given the slower deal environment, it does allow the companies to drive better terms, and you've certainly seen that across all the various products, be it private credit or bank market. So that they can drive better terms given in a slow environment or a slow deal environment that would be that. But at the same time, the last thing we would ever want to do is press someone into a decision, that they're not ready to make.
Yeah, good at all points in time. So if interest rates do begin to ease later this year or into next year, what kind of momentum do you anticipate returning to the middle market? And what should business leaders be preparing for now to stay ahead if we do see that interest rate shift?
Yeah, I think it's the number one question we've all been talking about for a while. But I think given where hold levels currently sit within middle market sponsor backed companies, I believe we could see a tremendous amount of activity in the back end of this year and into 2026 should interest rates begin to come down. And that coupled with the economic uncertainty of tariffs kind of continuing to abate. I know our M&A partners on the TD Securities side have certainly been actively pitching throughout the year. Which leads me to believe business leaders are already preparing for that shift, and more of when to go to market as opposed to if. And I think that's the same question that we've been trying to answer for the past 12 months as well, right? So but I do believe given those hold levels, we could have a really busy last back post Labor Day here in 2025 and then into 26.
That's great to hear. So is there anything else on this topic you think is important that we didn't cover? Any final thoughts?
No, nothing that really comes to mind. I think, again, we certainly remain open for business and look forward to supporting our clients as they kind of navigate this uncertain time. And we very much appreciate you inviting us on, and hope we can do it again.
Yeah, thanks so much for being here and having this conversation today. I appreciate it.
You bet. Thank you.
All right, thanks.